Reserve Bank of India is rethinking its large exposure framework following pushback coming in from the banks who say that the current lending caps are too tight. In fact, Vishwanath is joining us with more. Vishy, what are you picking up from your sources then?
Right. So, over the monetary policy announcement that the RBI governor made, there were a lot of announcements there. About 22 new sort of regulatory changes that the Reserve Bank is looking to bring in. We are bringing you details about two specifically, and that's on the lending caps that RBI implements on banks. Now, essentially what sources are telling NDTV Profit is that the RBI's decision to ease those lending caps were led by what happened in terms of demands from the banking sector. The banking system limits are the only ones that are under consideration for this large exposure framework. Essentially, individual banks will continue to maintain their internal limits as far as they are going to lend to these large corporates. It's only the system level limits. Let's try and understand a little bit more about what the system level limits actually mean. Banks currently have a combined capital base of 26 lakh crore, and if that is a capital base that you have, then 10,000 crore limit was going to be way too small. Now, if you were to look at what the review by the Reserve Bank of India aims to achieve, it essentially wants to free up the banking system and ensure that credit flow happens properly. Provisioning norms that were part of the large exposure framework were a key point of contention for the bankers, and that was becoming a problem for them to lend to these large corporates. If you were to look at what provisioning norms specifically, as a system, if you were to lend excessively to a corporate, you would have to make up to 3% provisioning towards that corporate, and that's why that was a problem. What we understand from our sources is that the large corporates have largely diversified their borrowing pool. Back in 2016, when the large exposure framework had come in, it was brought in so that bank dependence from the corporates can be brought down. What RBI said is that the 10,000 crore limit, if the banking sector is going to lend more than 10,000 crore to a single corporate, then they need to vastly diversify their lending or their borrowing. The corporate needs to diversify their borrowing. Currently, if you were to look at where the rules are, a bank individually cannot lend more than 20% of its capital base to a single borrower, and if it is a group of borrowers who are part of the same group, then the large exposure framework maintains a 25% of the capital base as the limit, and that is key. That was one of those key contention sort of areas. Coming to the second one, that's the more interesting one, which is about bank-owned NBFCs and the kind of businesses that they can do. What we learned from our sources is that banks were feeling that the draft norms that were released in October last year, they would make their NBFCs uncompetitive, because NBFCs that were not owned by banks would be able to do certain businesses, while those owned by banks would not be able to continue those businesses. As far as the draft regulations are concerned, originally, they were brought in to ensure that overlapping businesses can be restricted so that the same entity or the same group does not do multiple businesses within the same umbrella using different entities. But banks felt that that was too restrictive in nature. Using NBFCs as an extension of banks, that was one of those key concerns that the Reserve Bank of India has as far as these guidelines are concerned. What the RBI seems to be thinking now is that the bank board should be able to decide what is the appropriate business. So the RBI is not getting into that. And that's why the draft regulations, or the part about the forms of business, that has been actually withdrawn. That is what we understand from our sources about these directions that the RBI has come out with.